Right now, the global economy is holding its breath. Markets are locked in a tense waiting game, anticipating a definitive catalyst to break the current gridlock and release an immense amount of pent-up capital. Here in the United States, that gridlock is driven by an anticipated 2025 shift towards severe fiscal austerity. We are looking at sweeping, aggressive cuts to federal spending. This domestic drive for austerity is being spearheaded by a rising class of political disruptors, younger candidates and elder millennial appointees who are taking control of policy and demanding a more restrained approach to the government's balance sheet. Abroad, the standoff looks entirely different. Europe is rapidly rearming, which allows the US to pivot resources to the Pacific. In response, China is beginning to decouple from a weakened Russia, actively restructuring the global power dynamic. The collision of this domestic austerity with massive global restructuring has paralyzed institutional capital. Big money is sitting on the sidelines waiting for clarity, which has trapped retail investors in what we call a liquidity desert. You can see the effects of this desert most clearly in the crypto markets. Without institutional momentum, Bitcoin has been grinding sideways, trapped in a highly restrictive channel between $60,000 and $70,000. This chart shows a liquidity desert. Bitcoin's price forms higher lows, but trading volume has flatlined. Underlying demand isn't there. Compounding this, a massive roadblock of overhead supply, investors waiting to sell, sits heavily in the $82,000 to $84,000 zone. Recently, we've seen modest capital inflows from spot ETFs, exchange-traded funds allowing institutions to buy Bitcoin. But right now, those inflows are too weak to punch through that $84,000 ceiling on their own. This creates a brutal dilemma. Passive holders feel stagnant, watching their portfolios go nowhere, while active day traders bleed their capital dry by forcing low-probability setups in a market that refuses to trend. Surviving this phase requires abandoning standard middle-of-the-road strategies. You have to choose a definitive lane. Either you adopt extreme microscopic precision, or you commit to extreme macroscopic patience. Let's start with the active precision path. If you have the time to sit at your desk, this strategy allows you to exploit micro inefficiencies in a market that is otherwise chopping sideways. The primary footprint of these inefficiencies is called a fair value gap, or FVG. An FVG occurs when sudden, violent buying or selling pressure overwhelms the order book, creating a literal gap in the market's pricing. A fair value gap is always a 3-candle sequence, triggered by one massive, impulsive middle candlestick. To isolate it, measure the empty space between the first and third candle wicks. The market abhors a vacuum, so prices gravitate back to fill this void. Your strategy depends entirely on direction. You are either looking at an undervalued, bearish FVG or an overrated, bullish FVG. This visual shows an overrated FVG. The asset is overheated and trading above fair value, mathematically due for a pullback into a historical demand zone. Active traders use this pullback to set precise targets, placing orders exactly at the gap's boundaries. The trade-off for this precision is steep. It demands relentless screen time and intense focus to hunt down fleeting, rapid-fire setups on 15-minute charts. While fair value gaps offer a clear mathematical edge, executing them in a low liquidity market exposes you to a lethal, invisible risk: total execution failure when you try to exit the trade. That execution failure usually comes in the form of slippage. Slippage is the painful discrepancy between the price you expected to get filled at and the actual price the exchange gives you. In a liquidity desert, it is the silent killer of retail traders. When volatility strikes a thin order book, your only defense mechanisms are conditional orders, specifically stop markets and stop limits. A stop market order triggers the moment an asset hits your set price. It instantly converts to a market order, guaranteeing you get out of the trade no matter what. This matrix shows the severe drawback of stop markets. Execution is guaranteed, but you have zero price certainty. If the order book is empty, you're vulnerable to massive slippage, potentially selling for pennies during a flash crash. The counter mechanic is a stop limit order. It triggers at your stop price, but only executes at your specified limit price. The trade-off flips. You receive absolute price protection, but execution certainty drops. In fast markets, your order gets skipped. This is why precision FVG traders are forced to use stop limits. When a price wick violently stabs into a gap, a stop limit ensures they don't overpay for the entry. Your choice of order type acts as the mathematical expression of your risk tolerance in this fragile ecosystem. In a liquidity desert, attempting to play the active microgame and passive macrogame simultaneously is a path to ruin. You must pick a lane. To find your path, audit your lifestyle. Are you a full-time participant? If yes, choose Route 1, the precision trader. Commit to active FVG scalping. Narrow margins mandate using stop limit orders. If time poor, choose Route 2, the macro investor, abandoning the daily charts. Your protocol is patience. Wait for austerity policies and ETF inflows to shatter that $84,000 ceiling. To protect your capital, you must use stop market orders, placing them strictly at your line-in-the-sand ruin levels. For the macro investor, suffering severe slippage is an acceptable insurance premium. It guarantees you escape a sudden, catastrophic political shock before your portfolio goes to zero. Success in 2025's sideways market depends on the flawless execution of the strategy that aligns with your actual lifestyle.